Okay, lesson 6, this is budgets, just a quick one here. Sorry, I'm just having a look around for a pen. Right, lesson number 6, budgets. A budget is a financial plan establishing the policy to be pursued and anticipated outcomes of that policy. Sounds a little bit formal. A budget is a financial forecast, and then you can test to see whether or not your firm meets that forecast, and you can see how well that particular firm is doing. Now, there are 3 types of budget. There's a sales budget, which particularly for a new firm is a very, very hard one to sort out. There's an expenditure budget, which is probably a little bit easier because there'll probably be some data around the place where you can see what the costs of other firms are. You get a profit budget, which is the sales budget and the expenditure budget combined. And that's what a budget is. So we get 3 types of budget. The budgeting process is you set clear objectives and do some market research, and then you test your firm against those particular targets. The advantages of that is hopefully it will save a bit of money, you can measure performance, it provides an incentive for employees, makes departments accountable, and greater control of the business. Okay, and finally you get disadvantages of a budget. So it's my son talking to me. Disadvantages are costs are very volatile, business startup may lack the experience to work out what a budget should be, and if the budget is inaccurate then it can demotivate staff. So basically a budget is a financial forecast, a forward plan, and then you can test to see how well your business does against that particular budget. Thank you. Hi Boise, what do you want?
You done?
Yep.
I'm ready to go.
Okay, so this is a Unit 1 budget question which I've got on the board here, and fairly straightforward. The bits in blue are the bits that I've gone out and created myself. So what you've got on here is you've got an income statement here, and the income statement is obviously increasing every single year, and then we've got various expenditures, and we've got expenditures down here, and then we've got total expenditure down here. Now, if you can remember about budgets, you can either have an income budget, number 1, you can have an expenditure budget, number 2, and if you combine the 2 together, then you will get a profit budget. Now, so on this one here, we've got an income coming in of that amount, we've got expenditure of that amount, and this is sort of at grade A level. If you can then say in your head, well, this is just a forecast, and secondly, if we do 66,000 minus 103,000, we are going to make a loss in our first year of £37,000. However, in the second year, according to the figures, we'll make a profit of 13,890. Same process again, and same process again. So during the whole of this process on here, the profit is going up every single year. So depending on how much has been invested in the business, you would tend to think that this is quite a solid business. If I can remember correctly, I think it was something like £120,000 had to be paid for the site. So that would tell us that this was a reasonable investment to do. Now we could go on from there, because it also says in the passage that Max, because it's Max's idea, Max thought that sales would go up by 33% or income would go up by 33% every single year. So that's how we got these figures. Now the first question you would ask is, well, how does Max know that he's going to make 33% sales every single year? And that's a pretty big assumption to make, because if he doesn't make 33% every single year, then all these profit figures here are going to be incorrect. The second thing you could also do, but that'd be really pretty sharp, is to say, well, okay, well, what happens about 2017 if income goes up by 33% again? Keep it really simple. Let's just pretend the costs also go up by 33%. Then the profits are going to go up to 63,360. That is manipulating data. That is good analysis. So that is grade A type work. We could also actually work out the net profit margin, but remember this is a Unit 1 question. We could work it out, but this is more Unit 2, because that will be profit divided by the income divided by the sales revenue. So here's the profit, 13,890 divided by 87,780, and that gives you a net profit margin of 16%. So you could also work out that. So from this one piece of data here, we've got an enormous amount of information which we can then use. So as soon as you're using this data, you're going to be getting at least reasonable application, if not good application. And you can certainly begin to get good analysis if you manipulate the data from there, and all that is grade A. Now the question is going to be, should Max go ahead with a paintball? Yes, if his figures are correct, this looks a pretty good investment. Okay, so you can also come up with a judgment from there as well, just by looking at some data. So this is what I'm trying to tell you. If you can look at data very, very quickly and come to an appreciation of what all this means within 30 seconds, you're going to be a top grade candidate. So this is a Unit 1 question, and I'm now going to show you a Unit 2 question. Thank you. A Unit 2 question on budgets, and this is for 1 month of the year. And what we need to be able to do is we need to be able to look at this data very, very quickly once again and come to a summary about what's going on. Now, as this is Unit 2, what you tend to have is you have a budget, which is your financial plan that you think the firm will do. So this particular firm thinks they'll make £159,000 worth of sales in that month. The actual reality is that they only made £140,850 worth of sales in that month. So therefore there is an adverse variance of £18,370. So that's clearly not good. Their sales revenue is not as good as they thought it would be. But when we look at the whole budget, we can see that the firm is in fact making more money. Now, how do we work that out? Well, what they give us is they give us all of the bits in black, and they don't give us any of the things in blue. So once again, this really is a profit budget, so we can work it all out. And if you do 159.22 minus 138.65, that's 138,000 by the way, 650 quid, it comes to a profit of 20,570. That is what they think will happen. If you work out the actual profit, we do 140,850 minus 113,950, then we're going to come to a profit of 26,900 quid. So even though the sales revenue has gone down, the profit has in fact gone up. Now, why is that? Now, really then instinctively, you're sort of asking students to recognize what a profit and loss account is. And a profit and loss account is sales revenue minus variable costs minus fixed costs is equal to profit. Now, the vast majority of students will not be able to do this because they've done Unit 1 and they've forgotten about it when they're doing a Unit 2. But in the back of your mind at all times, you must think profit is always this. It's just something that you should definitely know. So when you look at all of this, you'll then be able to say, right, okay, so what's happened here? If sales revenue has gone down, it must be the case, but you're making more money, it must be the case that the costs have fallen by a much larger amount. So then we can look at the costs, and the stock control is far more effective because they did spend £68,510 on it. They're now only spending 52,070 quid. So therefore they got a favourable variance of £16,440. So clearly that is a good thing. Now, if we go to the end of the day, overall we have a favourable variance of £6,330. Now, overall then, the firm is now making more profit. Now, why is the firm making more profit? The firm is making more profit, and this is really astute, because the firm is controlling its costs far better. You would then definitely get good application and actually pretty reasonable analysis from that. If you then worked out the net profit margin here is 12.9%. What is the net profit margin? Net profit divided by sales revenue times 100. And then we can also work out the net profit margin for the actual as well, which is 19.1%. Now really from that, the question, from that we can say that whoever is running this business is doing a pretty good job. The only slight concern is, however, if we're being really detailed about it, they're spending less on marketing. Well, if you spend less on marketing, maybe that's a reason why their sales are not as high, and maybe that's a false economy. And also they're spending less on wages and salaries. Now, maybe, however, this may lead to demotivation of the workers and may lead to less productivity, so that may affect your costs in the longer term. However, overall, we have to say, just by looking at this here, the people who have run this business have done a pretty good job in terms of their financial performance. So, this here is looking at a budget, but actually in the back of your mind, you've got to know what a profit looks like, and you've also got to know net profit margin. But the question doesn't ask you for any of that. You just have to recognize that those concepts can be applied to this particular question. Okay, so that is the end of budgets. Thank you.